All right. We're up to social insurance. Cool. And previously, the key thing to remember about insurance is that was raised in the last lecture is that there's an information asymmetry between the user or the purchaser of insurance and the provider. And information asymmetry in general can cause market failures, if not market collapse. Because the user, the purchaser knows a lot more about, their behavior, habits, activities they like to get up to than the insurer, like how risky they drive, quality of their food that they eat, stuff like that. And so I assume we'll get more into that in this one. Let me get the audio working. There we go.
Let's get started. I'm a little under the weather today, so but don't take my lack of enthusiasm, my slower style today for lack of enthusiasm about the topic, because today we're going to cover one of my very favorite topics in economics and the one I've devoted a lot of my life to studying, which is social insurance. So today we're going to start back where we ended. We're going to start back where we ended the last lecture. Remember the last lecture we talked about information imperfections. We talked about uncertainty, and then we talked about why people would want insurance and why people do spend trillions of dollars on insurance. But we also mentioned the government also spends trillions of dollars on insurance, and we asked why. And the answer lies in the problem of asymmetric information. Now, in the used car market example I covered last time, buyers know more about the car they're selling. Sellers know more about the car they're selling than buyers know. And that asymmetric information led the market to potentially collapse. In insurance markets, it's the opposite. Here, the buyers know more than the seller does, but the problem is the same. So for example, suppose you want to start a new health insurance company for MIT graduates. MIT graduates need health insurance, so you want to start a new company. You figure these are pretty healthy people. Health insurance will be cheap. Indeed, you figure you have data that says there's 100, that out of a class of 100 graduates, let's say you consult 100 graduates, 90 of them are very careful people. And the only risk, once again, like last time, is getting hit by a car. And for those 90 people, there's a 10% chance that they'll have a $10,000 bill, and a 90% chance that they'll have no cost. That's the expected cost for those people, for those careful people.
$10,000 bill, he said?
90% chance that they'll have no cost.
And I guess this
that's
is per
the expected
year,
cost for those people.
Period of time.
For those careful people. Now, for the less careful people, or we often refer to as the sicker people, let's do this with sickness. Let's not do this with car accidents. Let's just say there's illness you can get. We'll call these healthy people, the healthy types H, have a 10% chance of getting this sickness and 9% chance of nothing happening. The sick people, and then the remaining 10 people out of the 100 have a 50% chance of getting sick and incurring a 10K bill, and a 50% chance of nothing. And that's the sick people. Okay? This is all data you know. This is data given to you that is statistically accurate. It's a separate issue about what about when you don't know the information. We'll come back to that. But for now, imagine you know this information. Okay? So what you usually say, look, I then know the expected value of buying insurance to MIT students. When I sell to those 100 people, my expected cost, if I sell those 100 people, my expected cost is what? Well, my expected cost for the healthy people is 1,000, a 10% chance of 10,000. My expected cost is 1,000 for the healthy people, and they are 90% of the population. Okay, so 1,000 expected cost for healthy people, they're 90% of the population. And for the sick people, I have an expected cost of $5,000 because they might get sick 50% of the time, and that happens 10% of the time. So by simple statistics, my expected cost is $1,400. So I expect that when I sell insurance, I will pay out $1,400. Okay? So I say, well, if I sell insurance for $1,500, as long as people are a little risk averse, they'll want to buy it, right? $1,400 everyone want to buy as long as they're not risk loving. If I charge $1,500, then then at least the risk, unless people are a little risk averse, they'll buy it. And I can make a profit. So I roll in and I sell insurance for $1,500. And I make a tidy profit, I think, of $100 on 100 people, which is $10,000. Why am I wrong? Why do I not, in fact, make that profit? Why, in fact, might I lose money? Why is that math wrong? Why if I offer $1,500, might I, in fact, lose money?
Everyone's going to buy it?
Yeah, because I assumed everyone buys it. But I don't have the power to make everyone buy it. So who's actually going to buy it? Well, let's think about that. All the sick guys,
people,
if I charge $1,500, this is an incredible deal for the sick guys, right? The expected value of them with insurance is $5,000, and I'm charging them $1,500. And they're risk averse, so they're like, this is a great deal. What about the healthy guys? Well, the expected value of insurance to them is $1,000, and I'm charging them $1,500. So unless their risk premium is $500 or more, they won't buy. So let's imagine some distribution of risk premiums out there.
So we need to figure out their risk, like how much. Yeah, well, the risk premium that the healthy people the average risk premium. Well, I mean, assuming that they all have the same risk premium, figure that out. Figure out figure out what the risk premium would need to be in order for them. Yeah, well, if we figure out their risk premium, then we know how much we can sell insurance for them all to buy it. And then basically, then whatever that amount is going to be lower than the sick people's risk premium because they know that they're sick, so it'll be much higher. So as long as we figure out the risk premium with the healthy people, then we can sell to everyone. And then I guess if that value is going to give us a profit, once I mean, like, depending on how realistic you want to get, you factor in all your other costs. As long as that is going to give you a profit, then you do the business, and then you provide the insurance.
And let's imagine that it's such that only half the healthy guys decide to buy when I charge $1,500. That half number is just I made up. But there's some distribution of risk aversion. Some healthy guys are super risk averse.
Okay, so I guess the other question is, like, if you could figure, if they have different risk premiums, if the healthy populations have different risk premiums, then you should figure out. Well, I mean, the first thing you need to figure out is your cost. So assuming you know your cost per person. Oh, I'm thinking of, I'm trying to make this too realistic. Because we know I'm like thinking about it in terms of, all the other costs that would come to running a business. But like if we should just focus on the money here, right? Yeah, okay. So I guess you just figure out how many healthy people how many healthy people and at what price you need to sell it to everyone at. How many healthy people you need to buy the insurance at a given price in order for you to break even or make a profit, basically. But then in reality, the hard part is figuring out what their risk premiums are. Right?
Easily, they'll happily buy $1,500. Some aren't very risk averse. They won't buy $1,500. Let's say half buy. So now what do I pay out? At the end of the year, what do I pay out? Well, to my sick people, to my 90 sick people, I pay out, to my 90 sick people, I pay out on average $45,000. Okay? I pay out on average, I'm sorry, for my 10 sick people, I pay out on average $5,000. Okay? That's what I pay my 10 sick people. That's my expected payout. What if for healthy people? I said only 45 of the healthy people choose to buy, right? So for those people, I have a 45 times a $1,000 payout in expectation. So my payout is $95,000. Okay? For 45,000 people. Okay? For 45 people. But what's my revenues? Well, how many people have I sold to? 60 people. 10 sick and 50 healthy. I'm sorry. I've sold to 55 people. 10 sick and 45 healthy. Okay? what's 55 times 150? Well, 55 times 150 is only 82,250. So I have paid out $95,000, but I've only collected a little more than $82,000. So I lose money. Therefore, I don't offer the insurance. This is the flip of the car example. In the car example, because I don't know what's a lemon and what's not a lemon, I don't buy the car. Here, because I'm not sure who's sick and who's not. If I offer at that price, I'm going to lose money, so I won't offer it. Now, you might say to me, well, that's because you were dumb. You chose too low a price. What if I just raise the price to $2,000? Maybe that'll solve my problem.
Less people are going to
well, $2,000, I make a lot more money per person. But what else happens at $2,000? Even fewer healthy people buy. So if at $2,000, only 10 healthy people buy instead of 45, I'll still lose money. The point is, this problem of what we call adverse selection, which is only the people on whom you're going to lose money want to buy, screws up insurance markets. Once again, let me be clear on this. Since only the people for whom it's a good deal want to buy, and you lose money on the people for whom it's a good deal, you make money on the people it's a bad deal, right? It's a bad deal for the healthy. If you charge more than 1,000, it's a bad deal for them. You're making money on them. So essentially, what's insurance doing? It's taking money from the healthy, extra healthy, to cover your costs on the sick. That only works if the healthy will play. If the healthy won't play, it doesn't work. Okay? Questions about that? So what happens in the real world? Well, if there's 5 possible outcomes here. 5 possible outcomes. Okay, outcome 1. Outcome 1 is the one good outcome, which is the healthy people are so risk averse, enough of them buy. So if there's enough risk averse healthy, then you can make this work, right? If something like 70 of the 90 healthy people buy, I don't know, I forget what the crossover point is. We should add that to the notes. By the way, there's an error in the notes, just say 45, not 50. And we should add what the crossover point is. Can't do it in my head. But there's some crossover point where if enough healthy people buy.
Adverse, or averse? I think it's adverse. Both adverse and averse are used to indicate opposition. What? How can these words be so similar? What? Adverse, detrimental, unfavorable. Oh, averse. Okay, these shouldn't be so similarly spelt. So it's averse here. Risk averse. Okay. So risk of healthy people will be lower than sick people. In order to calculate expected profit or expected cost profit, need to determine the risk premiums of each each person / group. Yeah, and then basically if there's a point where, hold on. What are my axes? Cost of the insurance. Cost of the insurance versus quantity sold. I mean, yeah, so if the quantity is high, right? Quantity high. I mean, cost is high, quantity sold will be low. So, and then of course, okay. So we've got the demand and supply, right? Of insurance, And so the this is not quite real. Because it's almost like, because you have two different groups, you need to have two different demand and supply. Well, two different demand curves, right? Because like, say, demand cost low. Hold on. Cost high. No. What? Hold on. My poor brain. No, this. Hold on, let me have some coffee. What am I confused about? The sick people have a higher risk premium because they know that they are sick and more likely to need the insurance, right? Therefore, they're willing to pay more for the insurance than the healthy people. And so let me close that. Demand. Right. Okay. So then there would be another one here. This would be the healthy people. Right? Hold on. Right. Do that. Because this would be the sick people, this would be the healthy people. Because if the cost is high, Because for the same, let's say for this, because for the same price, let's say here, right? Let's go here. The demand is much higher. Yeah. Yeah. Whoops. Get rid of that. Oh, no. That's S for sick. Whoops. So, I guess you need to have two different calculations for you'd want to split these two out. Or you want to make as many really as you need for however many different types of groups you have that you're providing insurance to, and then somehow combine them to say at a given price, or maybe you can have it all in one graph, but like somehow you need to figure out, okay, if I set one price for all of them, am I going to make profit, or how much am I going to make? And then if marginal benefit equals marginal cost, you provide the insurance up to marginal benefit equaling marginal cost, I guess.
I will make money at $1,500 or $2,000. So the first outcome is it all works out. Yes, there's adverse selection, but it's not so bad because the healthy are very risk averse. That's outcome one. Outcome two is the market collapses. The market fails. Why does the market fail? Because at any price, the adverse selection is so bad I can't make money. I never get enough profitable healthy to cover my unprofitable sick. So the market fails. That's the second possible outcome. There's a third outcome. I could just sell to sick. Let's say I rolled in and I said, I've got insurance for MIT graduates. It's going to be $5,500. Well, at that point, as long as the sick are somewhat risk averse, they'll buy it. Or if they're $5,100, if they're all risk averse, they'll buy it, and I'll make some money. So I could just sell to sick people.
Essentially, this is differentiating by consumer.
That high price, no healthy people don't want. If the healthy want it, great. Go for it. I'm happy to have them. But that's just icing. I then make money on the sick as long as I set the price above $5,000. So that's another thing I can do. I can just have a health insurance policy for the sick, priced at the price for the sick. And I know the healthy just won't take it. Or if they do, it's only icing. Okay? A fourth thing I could do is I could just discriminate.
But isn't it? Oh, I guess this is differentiated by consumer type, but you're only selling to one group. One group. But then I guess it's, discriminating for every group and selling to them all.
I could say I'm going to sell insurance at $1,500. I'm going to test you when you come in. If I find you're sick, I'm not going to sell to you. If I find you're healthy, I'm going to sell to you. Turns out, totally legal until the Affordable Care Act passed. So for most of my life, insurers were totally legal to say, if you're sick, I'm not going to sell you insurance. Or if you get sick, I'm going to drop you from insurance. As I hope you can see, that sort of undercuts the whole...
Affordable Care Act, US. Healthcare reform enacted. 3 primary goals. Make affordable health insurance available to more people. This law provides consumers with subsidies. The premium tax credit that lowers that lower costs for households with incomes between 100 to 400% of the federal poverty level. Oh. What is the federal poverty level for? US, just little tangent, federal poverty level. In Australia, federal poverty level. Federal 2026. $22,600. What is it for Australia? Poverty line. No nationally agreed definition way of monitoring poverty. What about what is the poverty line? Poverty Australia poverty line. Poverty line. Two poverty lines: 50% of median income, 60% of median income, whereby people living below these incomes are regarded in poverty. $30.3. Interesting. Okay. Versus 22.6, but I guess that's not taking into account like how do you account for purchasing power? But I don't know. Anyway, interesting. So Affordable Care Act. So this is doing right. So if you're earning between 100% to 400%, I guess it probably would progressively decrease the decrease as you get closer to 400%, maybe. Spend Medicaid to cover all adults with income below 138% of the federal poverty line. Below what? I wonder why 138% was picked. Not all states have expanded their Medicaid programs. What innovative medical care delivery methods? Okay. Okay. Cool. Let's keep going.
The whole idea of insurance. The whole idea of insurance is to get healthy people to cross-subsidize sick people, and you drop people as soon as they're sick. Then it doesn't really provide insurance. So insurers were totally free to do that.
So this must be like a sub goal done by added by the Affordable Care Act, like whereas what we read was like the primary goals
for the Affordable Care Act passed. I'll talk more about that at the last lecture. Okay. Finally, there's a clever solution, which the math is hard, so I'm just giving the intuition, which is you can sell different products. That is, what I can do is I can sell two products: comprehensive insurance for $5,500 and crappy insurance for $1,500. As long as the sick people don't want the crappy insurance, then what have I done? I've solved the asymmetric information problem by getting people to reveal their underlying health. Remember, my problem is I don't know who's sick and who's healthy. I know the aggregates, but I don't know who's sick and who's healthy. If people had sick and healthy stamped on their forehead, I'd be done. But I don't know that. But if I offer a very good product that's expensive and a shitty product that's cheap, people will tell me their type by what they buy. The healthy people buy the crappy product. Sick people buy the other product. I'll make money on both. So that's another thing I do. Have you ever heard of an HMO? That's what an HMO is. Okay? Basically, that's what we've done with health insurance in America to try to deal with this problem, is created less high-quality insurance for the healthiest people that they can buy cheaply. Okay, so that's another thing we can do. Okay? Here's the key point. All of these are market failures. All of them. They may say, oh, no, that's a market failure, but why is that a market failure if you just sell to the sick? Why is that a market failure?
Well, it's a market failure because there are healthy people that want to buy insurance at some price, and they're not able to, right? So it's a trade that could be happening that isn't happening, and that could happen if, and so healthy people want to buy it, and insurance companies want to provide that, but because they don't know they don't have enough, but because the insurance companies don't have enough information to about the healthy people, of who the healthy people are, they can't make that trade happen.
Yeah. Yeah, there are trades that with perfect information I would be happy to make and they would be happy to make them not being made. So as long as imperfect information asymmetry, leads to trades not being made that make both sides better off, then that's a market failure. So let's say it's a market failure. Likewise, if I discriminate, that's a market failure. Because there's sick people who would happily pay me $5,200 for insurance. But I don't know who they are, so I can't sell them at $5,200. Finally, even selling different products is still a market failure. The reason is because what you can see from the insurance...
Oh, hold on.
$200 for insurance failure. Likewise, if I discriminate, that's a market failure. Because there's sick people who would happily pay me $5,200 for insurance. But I don't know who they are, so I can't sell them at $5,200.
Hold on.
Likewise, if I discriminate, that's a market failure. Because there's sick people who would happily pay me $5,200 for insurance. But I don't know who they are, so I can't sell them at $5,200.
But isn't... I'm confused. I thought discriminating was where you are basically changing your price depending on the person. And so this assumes you know... Oh, hold on. Maybe I'm confused about what discriminating is, because...
Finally, even selling different products is still a market failure. The reason is because what you can see from the insurance model we set up last time is a typical risk-averse consumer wants complete insurance. They don't want partial insurance. They want to basically make sure that their consumption's the same, no matter if they get hit by a car or not. And partial insurance isn't as good because, once again, the extra they keep doesn't compensate for how much they lose if they get hit by the car.
But isn't that assuming something about the partial insurance? So, like, can't you make the partial insurance better over time to more, and you can make many different versions of the partial insurance, and that's kind of what insurance in Australia has done, because you can I mean, like, okay, so let me so, like, how I'm understanding this is, say we have like different types of insurance here, different types of things that we're insuring for, like health, car, whatever, right? And say a consumer has perfectly calculated the risk premium for all their activities, and it looks like this, right? And what he's saying is, well, the partial insurance, isn't perfectly matching this. It's more like maybe we're missing out a few things. Maybe it's like this, right? And so isn't that just something that you can gradually fix over time, or like improve over time? So like what we have in Australia is basically you can just tailor your insurance to whatever you want, and you can tailor like the payout amounts, tailor the risk premiums. You have a lot more flexibility, and so you, the user, can make the insurance look more like this. The consumer, sorry, and basically, reveal your preferences. You're revealing a lot about your health and stuff, right?
So incomplete insurance is...
So I don't... But this can be improved by giving consumers more options for tailoring their insurance. Category.
This is also a market failure.
Let me get back.
Okay? They do, it's only icing. Okay? A fourth thing I could do is I could just discriminate. I could say I'm going to sell insurance at $1,500. I'm going to test you when you come in. If I find you're sick, I'm not going to sell to you.
Oh, that. Okay. I was thinking of discriminate differently because I thought discriminate meant, you basically sell different insurance to different people. Because that's what he meant when he was talking about monopolies discriminating, price discriminating. So this is so different. This is not consistent. Okay. So, but it's discriminating, but it's a different type of discriminating as to what a monopoly would do. Okay. So, discriminate. So this is, let me note, different to price discrimination per every consumer, like described in the Amazon monopoly example. Of course, it's a note to self. Who else is going to be reading this? What? Set price to $1,500. The amount profitable for you when only selling to healthy people. Test people as they come in. If they are sick, don't sell to them. So just example. Okay. So this is basically just sell to sick people. It's not discriminating because you're just different to discriminating because you are just setting the price that allows you to make a profit if only sick people buy it, and healthy people will automatically not buy it. No discrimination required. Okay. Discriminate to only sell to healthy people. Okay. Yep.
That's also a market failure. So the point is, unless you have enough risk-averse healthy, the market will not deliver the welfare maximizing outcome.
Okay, I can. That's
Okay. Questions about
that.
that? Okay. So now, once again, as I said, the principle that I teach in my classes is the market knows best until the market fails, and then there's a potential role for the government.
Because our trades would have it if. Adverse selection. I think it's adverse here, and then averse selection, adverse selection. Oh my god! But then people are averse to. Oh no! Oh no! Okay. Oops. Okay. Oops. Nope. This one. So. Okay.
But it's only a potential role for the government. And the reason it's especially confusing here is there's many different ways the government could come in and solve this problem. And in fact, governments around the world do this in 3 different ways. They solve this problem in 3 different ways. The first way, so what about government solutions? The first way governments solve this problem is with subsidies.
And so that's what
Let's
we
go
just
back to
read
our
about in the
example.
Affordable Carrot.
What if I said to everyone who's an MIT graduate, I will give you $500 if you buy insurance? Then the original product would work. Because the $1,500 I would charge them,
Right.
like let's say I, the government, say, I'll give you $500. Well, the insurance I'm offering is $1,500, so it's then a good deal for both sides. So they both buy it. So in some sense, one way to combat adverse selection is through price. If you make it cheap enough, the healthy will buy. So subsidies just naturally offset adverse selection. If I get $500 subsidy, in my previous example, it's a good deal for everyone. And everyone buys, and we get solution 1. We get this one. Everyone buys. Okay?
But when he says MIT graduates, well, no, I guess it is to both groups. Basically subsidizing the entire market. But then, does that work? Because doesn't the insurance market just lower? Like, aren't they then still forced to lower the price to compete with other insurers? And then don't you just end up with the same problem, but instead $500 is coming from the government instead of people? Or because don't the insurance companies just price in?
That's one option. Indeed, we use that option a lot in the US. In the US, we massively subsidize private health insurance. How do we do that? Well, one way we do it is through our tax code. Here's an interesting feature of our tax code. If MIT pays me in wages, I get taxed. I'm not giving away too much private information. Say if you add up the tax rate I paid in Massachusetts and to the federal government, my tax rate approaches 50%. So I get to keep about half of what I make. Okay? But if MIT gives me health insurance, it's not taxed. So if MIT says to me, John, do you want $1,000 in health insurance or $1,000 in wages? I say, wait a second, if you give me $1,000 in wages, I get to buy $500 worth of goods. If you give me $1,000 worth of health insurance, I get $1,000 worth of health insurance. I'll take the health insurance. And that is partly why most people in America get their health insurance through their employer. We bribe them to. We bribe them to by taxing their wages, but not taxing their health insurance. That's a massive subsidy. That costs the US government $300 billion every single year. Big money that we're paying to bribe people to buy private insurance. Okay? So that's one example of how a government can come in and try to solve this problem. A second example is through a mandate. Any of you followed healthcare policy debates when you were younger remember this term of the mandate. It was a big centerpiece of the debate over the Affordable Care Act.
Well, for workers, for isn't too important to remember.
Just what if I just say everyone has to buy? I say healthy, sick, alike, you have to buy. Then basically I get this outcome again because I force everyone to buy, so I know what the price is. Remember, I know in aggregate what the price should be. I just don't know who's going to buy and who's not. So I force everyone to buy. Everyone comes in, and I know what price to set. Okay? Now, you might think, well, gee, that seems like a way better option than option one. Option one costs the government a ton of money. Option two costs the government nothing, other than just say buy insurance. But in fact, who gets upset when there's a mandate? Which particular group is most upset?
Well, the healthy people.
The healthy, who are not super risk averse. They are getting hit. They didn't want to buy insurance at $1,500. You're forcing them to do something they didn't want to do. That's politically very challenging, as we learned with the Affordable Care Act. Okay? Which is that it's politically very challenging to force people to do something they don't want to do in the American political system. So in some sense, you can think of a mandate as sort of implicitly forcing the healthy to subsidize the sick. That's great because it gets the government out of the way, but it's essentially pissing off the healthy, non-risk averse people. And believe me, during the Affordable Care Act debate, every single one of them sent me an email. Okay? People did not like that feature of the mandate in the Affordable Care Act, and eventually the mandate.
Look into how this works in reality. Vibe's intuition is that vibe reality. Would do the insurance companies I mean, okay, so like say to be profitable, well, say to break even, right? The insurance company, say to break even, the price needs to be 1,000, right? And that's to break even when selling to everyone, healthy and sick. And the government gives everyone $500. is the firm going to keep their price at 1,000 or change it? That's and assuming perfect competition. So basically, look, okay, so the marginal cost of providing insurance isn't changing. Um, and it's not the right way to think about it, because because it's not like because we're assuming a set number of consumers as well, so it's not like the firm is changing the amount that they're supplying. So the supply is set, and so it's not like you can just produce more until marginal benefit equals marginal cost, and then that's how much you produce it. But so the supply is set. This would be. I want to read. Oh yeah. I want to read something about this. So yeah. Just put my thoughts down here for now, and then we'll come back to it. Do the insurance firms somehow price in the government subsidy and are forced through competition to alter their prices until the same market failures appear? I don't know. I don't really. Yeah, I don't really know. I don't know. I don't even know if that's the right question, but like that's sort of my vibe. I'm wondering if there's some whatever.
Okay, but we have mandates.
I'm sure. Like when we read something about it, it'll, they'll have obviously thought about it way more.
Okay, for example, the oldest program of this type in the country is called workers' compensation insurance. That's a program that ensures if you get hurt at work. That's been a mandated benefit of employers since the early 20th century. No one's protesting workers' comp mandates. In most states, you're mandated to buy auto insurance. People don't protest that. They bitch about how expensive auto insurance is. People don't protest it. So interestingly, mandates are not a new concept brought up by the Affordable Care Act. It was just in this application that got people very upset. The final option for the government is you can just provide the insurance. Cut out the middleman. Say, sorry, John, we're just going to have GovCare. It's going to be whatever it's going to be. If we lose money, we lose money because we're the government. We don't need to break even. We're just going to provide it. Obviously, you can combine it with subsidy. Say, provide it, we're going to subsidize so everyone's in. Or you just provide it and make it free. This is what most countries do. Most countries say we have a national health insurance system. It's free. Take Canada. When you're born, you're entitled to national health insurance. It's free. You just go. There's no adverse selection because it's free. Once that's free, there's no adverse selection. Okay? So that's another way you can do it, have the government just provide it. Indeed, that's what most of the world does. Okay? Questions about any of that? Yeah? No, mandates help private insurers because when you mandate, you're giving them more customers.
This helps private insurance.
Because what the government did is they wanted to make a trade. They said, we'll mandate insurance, but you need to stop discriminating. That was the trade. But they're saying, you're discriminating because of adverse selection. Here's the deal we're going to offer you. Stop discriminating, and we'll end your adverse selection.
Right.
Some people would rather discriminate, and they're upset about it. Okay, good question. Now, the bottom line is, this all sounds pretty good. We've got a problem. We've identified potential solutions. Most governments in the world are using some combination of solutions. What's the problem? Well, the problem is that there's another asymmetric information problem which poses a fundamental trade-off. And that's what we call the fundamental social insurance trade-off. And that other problem, that other asymmetric information problem, is what we call moral hazard. The other asymmetric information problem is what we call moral hazard. That's basically the adverse behavior that is encouraged by insuring against an adverse event. When you insure against an adverse event, you can cause adverse behavior. So basically, for example, if families buy fire insurance for their homes, they may be less likely to have a fire extinguisher in the house. They don't need it because their house is insured if it burns down. If people have health insurance, maybe they're less worried about taking precautions. Okay, I'm not feeling so well today. I decided I'd come in with a mask, be okay. But if I didn't have health insurance, maybe I wouldn't. You know, so basically, maybe there's risks people take. And then also, take another example. One of the biggest insurance programs in America is unemployment insurance. Insurance you get if you lose your job. Well, if we insure you for the money you lose when you lose your job, what's the incentive to search for a new job? Remember, leisure is a normal good. These are all forms of moral hazard. And the best and most fun examples come in the context of workers' compensation, which I already mentioned already. That's a $60 billion a year program that insures people for injuries that are job-related. The problem is, now you might think, well, that sounds like really sensible insurance. The problem is, a lot of these problems are actually hard to diagnose and hard to figure out if they're job-related. If someone is at a machine, you watch them saw their arm off. That's pretty easy. If someone says, I've been driving all day and I have back pain and I can't stand up, that's harder. Most of claims for workers' compensation today are mostly pain and mental health. Those are hard things to evaluate. As a result, and then on top of that, so you've got two problems with workers' compensation. One is it's hard to evaluate if people are really injured. The other is, if they are injured, they get a pretty attractive benefit. If you miss work and get workers' comp, you get 75% of the wages you would have gotten if you worked. So you can sit at home and get 75. Remember, leisure's normal. People would rather not work. So you can work or sit at home and get 75% of wages, but it's better than that because your wages are taxed and workers' comp isn't. So for a typical worker after tax, their workers' comp amounts to about 90% of what they take home working. So you got a program which says, look, leisure's a normal good. I'm going to pay you roughly 90% of what you'd earn at work. All you have to do is pretend you're hurt. That's a clear incentive for moral hazard. Okay? So basically the idea is that there might be moral hazard in something like workers' comp. And there's been a large, really fascinating literature that's tried to measure that. Sometimes there's fun examples. My favorite example was the woman who in what state? What state? I'm talking about bad behavior. What state am I talking about? Florida, right? Come on. So there's a woman in Florida who was at her desk. While she was at her desk, a sprinkler had fell out of the ceiling and landed on her desk and shocked her. She looked around, bonked herself on the head with a sprinkler desk, with a sprinkler piece, and claimed workers' comp. But of course, you know the reason I'm telling you the story is all on camera. Okay? Have you guys ever heard the show Wicked Tuna? It's about tuna fishing on a gloss about a guy who wrestles these 1,000 two-ton tunas onto his boat. Turns out the whole time he was on Wicked Tuna, he was collecting workers' compensation because he couldn't work. Okay? There are lots of fun, really fun examples. But what we care about in economics is not stories, we care about facts. And how do we test in empirical economics whether moral hazard is a real problem? Well, the way we do it is we say, it turns out that what you get from workers' comp varies across different states and over time. So let's say I'm in one state, Andrew's in another state. Andrew's state randomly raises the benefits. Now, there's no reason Andrew should be more injury prone just because the state raised the benefits. But if Andrew becomes more likely to be injured when the state raises benefits, clearly that's moral hazard. Because there's no other reason why, just because the state raises benefits, Andrew should be more injury prone. And the evidence is incredibly powerful. We talked about elasticities. The evidence is that for every 10% that benefits go up, people miss 10 to 20% more.
If workers' comp benefit increases, do people become more injury prone? But this is hard because people might be more willing to report real injuries, or if they know that the workers' comp benefit is higher. Like, suppose in reality you do have a back pain, but if the workers' comp benefit kind of sucks, and you need to work, then you're not going to report it, right? And so then that, and likewise, if the workers' comp benefit, as the workers' comp benefit increases, you're more likely to report the real injury. So that, and then that, this is tricky. It'd be, I wonder how they sorted all that out. Because so as you increase the workers' comp, people with injuries should be more likely to report it and get the workers' comp and take time off work. And people who don't have the injury are more likely to pretend that they have it, and engage in risky, and people might engage in slightly risky behavior. Oh. How do the studies account for people who have the injury being more likely to report that they have the injury if, as workers' comp rises, as opposed to basically continuing to work with the injury? Oh, there's a better way to say that, but yeah. Yeah, interesting. Okay, so what did he say here?
That benefits go up. People miss 10 to...
Where's the benefits to?
20. That benefits go up.
Hold on, let me go back.
And the evidence is incredibly powerful. We talked about elasticities. The evidence is that for every 10% that benefits go up, people miss 10 to 20% more work, an elasticity of 1 to 2. People are very responsive to these benefits.
But yeah, and so the why they're missing work, though, is because this in of itself isn't good or bad. It's bad if they're missing, they're missing it because they're pretending or whatever, or engaging in risky behavior. But it's good if, there are people who have legitimate injuries who are now willing to report and miss work in order to recover properly, as opposed to, not being able to afford to live on the workers' comp if the workers' comp was so low. So so,
and that's clear evidence of moral hazard.
U.S. workers' comp. Let's see if we can study. Let's see if this will actually pull something. So, Miss is not pressing. Oops. Anything? This isn't really what I want. Social Security Disability Insurance workers. Oh, okay. This is not really what I want either. I wonder. There wouldn't be. There's no way that there'll be. Yeah, there's gonna be nothing in the comments. I don't know why I bothered. I mean, yeah, this will unfortunately require a deep dive into workers' comp. But here's my question. This doesn't seem to necessarily be bad or good, since it's good if people who legitimately have an injury if people are reporting their are taking workers' comp at increased rates due to the increased benefits, allowing increased benefits. Bad if people who don't have an injury are pretending. And then bad if it encourages riskier behavior. And there's probably a bunch of other good reasons, good, bad. Okay, interesting.
Okay. So, moral hazard exists, but we might ask, look, so what's the problem? Okay, adverse selection, I explained the problem. The market collapses. That's pretty bad. Collapse, we know is a bad word. That's bad. What about moral hazard? Why is it so bad? Well, it's bad.
Moral hazard, adverse selection. Yeah, okay, this is an important one.
Bad for two reasons. The first is you remove productive labor supply. Let's just do some quick math to show why this is.
Well, I mean,
imagine
that's pretty self-evident. Because, if someone's pretending to be sick and they could be working, well, right? E.g., someone pretending to be sick and taking workers' comp. Someone, a healthy person pretending to be sick.
Then an individual is choosing between staying at home, is choosing for the marginal hour. Do I stay at home or do I work? Well, we know the way they'll make that decision is they will maximize their utility over consumption and leisure, subject to some budget constraint. And we know that this will yield the first order condition that du, dl, or the marginal utility of leisure equals the wage. Mm-hmm. That will be the equilibrium condition. Why? Because it's where marginal benefits equal marginal costs. What's the marginal benefit of staying home? How much happier it makes you? The marginal utility of leisure. What's the marginal cost of staying at home? You give up your wage, W. So an efficient market, this is a very important insight, by the way. Many people talk about work as a virtue. That is wrong. Work is not a virtue. Okay? People should only work until this condition is true. If you're someone who really hates work because you're really disabled, it's awful, you shouldn't work. It's not like God has said we must work. Okay? The optimal social condition is people should work until this condition is true, which means no one should work all the time. That can't be true 24 hours a day for everyone. At some point, you got to sleep. And some people should work less or more than others. Okay, that's what's optimal. Okay? Now, imagine that, and we know that the wage in a perfectly competitive labor market equals the marginal revenue product of labor. We know that's where the wage comes from, in a perfectly competitive labor market. Okay? So basically, think of this from the employer's perspective. From the employer's perspective, I take leisure until the value of leisure equals the value of what I produce at work. Okay, so basically that's what we want in society. We want people trading off the value of what they produce at work versus how much the value they get from sitting at home. But now suppose I tell you that for every hour you sit at home, you also get an amount G. Well now, if I sit at home, what do I get? I get du dl plus G. And I set that equal to the marginal revenue product of labor. So du dl plus G, I said equal to the marginal product of labor. Let's think for a second about what this does to my leisure decision. This means I set my marginal utility of leisure
above, I'm sorry, I set marginal utility of leisure below my marginal product because G is positive. I set my marginal utility of leisure equal to MRPL minus G. Does that imply more leisure or less leisure than what we know is efficient? We know efficient is DUGL equals MRPL. If DUGL plus G equals MRPL, am I supplying more leisure or less leisure than the efficient outcome? We know this. Yeah, go ahead. More, because remember, as leisure goes up, marginal utility goes down. We know we want more, since G is positive, to keep equal MRPL, DUGL has to go down. DUGL goes down by taking more leisure. So by offering this benefit, I've created an inefficiency. I'm causing people to take more leisure than is optimal. The optimal leisure would be DUGL because MRPL, but I'm making DUGL equal to MRPL minus G. So I'm causing them to take too much leisure. In other words, I'm getting in the way of productive trades. There's a productive trade to be made here, which is I work, you pay me. But now I'm like, fuck it, I'm not going to work because I get G. So that's a productive trade that goes away because of moral hazard. And that's why we care. That's a dead weight loss. Okay? There's a second problem, which is sort of minor but important, but remember, which is that how do we pay for social insurance programs? By taxing workers. The less people work, the more tax we have to raise on everybody else. So that means higher tax rates. Because if we're shrinking the base of workers, but we got to pay for all these workers sitting at home, that means higher tax rates. And we'll talk later about why higher tax rates cause inefficiency. So this leads us to the fundamental trade-off with social insurance. On the one hand, unless the government intervenes, there will be a market collapse, unless you get condition 1. And we have lots of evidence condition 1 isn't met in most markets. The market will collapse.
All of points 2 to 5 are market failures. Yep.
And that is bad. That's a welfare loss. On the other hand, by providing that insurance, we create an offsetting welfare loss, which people don't work as hard. What does that mean? Well, that has a simple implication, which is we should have social insurance, but it shouldn't be too generous. Clearly, the right answer is not zero social insurance, unless moral hazard is like deadly. I mean, this is just you're losing some product. This one, people starve if they don't have insurance. So clearly, we want some insurance. But if we have too much, we might encourage people to sit at home. So the idea is we want, in between, we want a trade-off. We want enough insurance so people don't starve, but not so much that we cause a lot of moral hazard. Okay? And to see that, let's talk about the largest social insurance program in America, which is the Social Security program.
The market failures of it, but not to offset the welfare loss of the market, of the free market failures, but not so much that the deadweight loss introduced by government provided insurance is greater than what it is offsetting. Well, that's not quite right, but it's not just deadweight loss, but not. But so much that the deadweight loss / moral hazards / other question mark are worse than the welfare loss it is offsetting. That's
We have a number of social insurance programs in America. I mentioned workers' compensation. You get hurt at work. I mentioned unemployment insurance if you lose your job. Our biggest aggregate social insurance programs are for healthcare. I'll talk about them in the last lecture. They're called Medicare and Medicaid. Okay? But the single biggest program of social insurance, at about $800 billion a year, is Social Security. Social Security is insurance against the income loss that comes from retirement. Social Security is insurance against the income loss of retirement. It's insuring you to make sure that once you're retired, you have enough money and don't starve. Let's talk about how it works. Here's how Social Security works. First, when you retire, you get a check from the government. You get a check from the government. Okay? That check is a function of how much you made before you retired. That check is progressive. What does that mean? That means that if you're very poor, you get a check that's almost as much as you made before you retired. If you're rich, you get a check that's about 30% of what you made before you retired. So you get a check that basically depends on how much you made before you retired, but in a progressive way. The more you made before you retired, the less you get back from the government. Everybody gets something. Everyone gets at least 30%. But there's a range 30 to 90. Actually, I'm wrong. It's at least 15%. There's a range 15 to 90, over which it varies. So Bill Gates will get Social Security. Sorry, I keep picking on Bill. He'll get Social Security, but only get 15% of his previous wages. Or you know, subject to a cap, so even less. Okay? You get this check until you die. It's what's called an annuity. This is an important term. Not a lot of people know, even financially savvy people. An annuity is the opposite of life insurance. We all know life insurance. Life insurance is I pay money while I'm alive, and when I die, my descendants get a check. Annuity is the opposite. Annuity is I pay money now, they send me a check as long as I'm alive, and then it ends when I die. So if I want to annuitize my wealth, what I do is I'd walk into a broker's office, I'd say, here's my money, I'm giving it all to you now, and you're going to send me a check until I die. Why is this appealing? It's appealing because we don't know when we'll die. And as a result, savings for retirement is very imperfect. Definitionally, you will always save. If you just use saving for retirement, always save either too much or too little. If you live longer than you thought, you'll save too little. If you die sooner than you thought, you'll save too much. Now, if you care about your kids, that's a different thing. But let's talk about a childless person. Okay? So basically, the point is savings is imperfect because you don't know when you're going to die. Annuities are insurance against that uncertainty. Think about it. Just like health insurance insures you against a medical bill, annuities insure you against how long you're going to live. You turn out to live a long time, then your annuity will turn out to be a good deal. You've paid them out and you get a check forever. If you turn out to live only a short time, your annuity will be a bad deal. Just like with health insurance. Health insurance, if you turn out to be healthy, health insurance is a bad deal. If you turn out to be sick, it's a good deal. But you still want it because you want to smooth your consumption. And that's what annuities do. Okay? Now, that is the benefit of Social Security. That we make sure that people have enough money till they die. They don't undersave. That they don't undersave and end up without enough money because they don't think they're going to live that long. They live a long time and suddenly they're impoverished. Okay? And indeed, one of the reasons we set up Social Security was because there'd be all these impoverished people, especially after the Great Depression. The main motivation of Social Security is the Great Depression wiped out a bunch of people's savings. And we were worried they wouldn't have enough money to live till their death. So we set up this program. On the other hand, there's a moral hazard element of Social Security.
People want to retire
Which is, remember,
earlier.
How do you qualify for Social Security? By retiring. Retirement is a choice. Leisure is normal. People would like to be retired. So the more generous we make Social Security, the earlier you'll retire. Because basically we're saying, go back to the math over here. Think about this not as a period-by-period decision, but a year-by-year decision. This year do I want to work? Well, this year I think, gee, how much should I value leisure if I sit at home versus how much will I make this year? And decide should I work or not? Well, now I'm going to be more likely to quit. Because if I quit, I get money I get if I don't work. So I've essentially put a thumb on the scale for quitting. I put a thumb on the scale for retirement. So the moral hazard aspect of Social Security is it causes increased retirement. Why is that bad? Well, because older workers are productive. Not that they shouldn't retire, but they should only retire when this condition's true, not when this condition's true. Okay? They're retiring too early. And in fact, there's tons of evidence from very well-crafted studies that Social Security has a huge impact on retirement. Okay? There's a really cool, and basically the way they study this often is by looking at the fact that Social Security has certain ages at which you're a minimum age, and when you lower that minimum age, all of a sudden everyone retires earlier, or you raise people retire later. In Germany, the minimum age was 60, and the average retirement age was 58. So people retire early because they have their own money. They raised to 65. Within 5 years, the average retirement age in the whole country of Germany was 63. Think about that. Within 5 years, an entire country changed when retired by 5 years. Pretty phenomenal. Okay? That illustrates the power of moral hazard. Illustrates the power. And that says there's a trade-off. So basically, the question is, how do you think about this trade-off? Well, you write down an economic model, and you talk about the benefits of insuring against longevity and the costs of early retirement, and you come out with some optimal Social Security number. This isn't what we do here. We'll do that in 1441 if you want to follow up. That's in 1440. We'll write down a model. We put both these things in one model and optimize. And you get some optimal level of Social Security. Turns out it's probably not that far from where we are. Social Security on average replaces about 45% of people's wages across everyone. That's probably not a terrible number, given this trade-off. Okay? But the problem is, this is a much bigger issue in Europe than it is in the US. Because of a seemingly harmless little tweak in the way we do Social Security versus the way Europe does Social Security. Social Security is an age of early retirement, the earliest at which you can get your benefits. So the way it works in Social Security in the US is as soon as you're 62, you can start getting a check. But if you wait till 63, we'll give you a bigger check. Why? Because you're going to get it for fewer years. Your death date's the same. See, like at 62, you're going to die at 160 to 100, and we give you X. If you get 63 to 100, we're going to give you X plus a little bit to give you the same total by age 100. So we basically have what we call in Social Security an actuarial adjustment. We basically look, the longer you work, the more money we'll let you keep. Because you're going to get fewer years of benefits. It's a trade-off. Okay?
Interesting.
The issue is getting this actual adjustment right can strongly impact
Actual? Actuarial? Actual? What was it?
people. We basically
Actuarial. Real. Actuarial. Difference between an employer's actual and expected pension payments. Actual gains and losses arise from changes in assumptions for the pension obligations. Actual gain or loss refers to an increase or decrease in the projections used to value a corporation's defined benefit pension plan obligations. The actuarial assumptions of a pension plan are directly Okay, actuarial. Adjustment.
say, look, the longer you work, the more money we'll let you keep.
Hmm.
Because you're going to get fewer years of benefits. It's a trade-off. Okay? The issue is getting this actual adjustment right can strongly impact people's work decisions. So let's do an example. Let's say you earn Y% per year. And Social Security replaces K% of that. Remember I said an average Social Security replaces about 45%. So K would be 0.45.
So EU doesn't have this?
5% in the US. So Social Security replaces about 45%, and ignore the fact that rich people and poor people are different. Imagine one representative person. That representative person earns Y, and when they're retired, they're going to get K times Y, where K is a number less than 1. And let's imagine that you're going to live until 80. Live till 80.
Does Australia retirement benefits have actuarial adjustments? Only actual adjustment. What year is this? 2015. Okay.
And you're deciding, should I retire at age 62 or not? Should I at 62 or work till 63? Well, if I retire at 62, what do I get from Social Security? Well, I get the present discounted value. Remember, I got to PDV it because the money's coming in the future. Okay? Of getting 18 years of K times Y. I retire at 62. I get it for 18 years. And it's going to be in the future, so I got to PDV it. If I work till 63, what do I get? If I work till 63, well, then I get Y, I get the PDV of Y this year plus 17 times K times Y, because I get it for one fewer year. So what's the difference between these two? The difference between these two is 1 minus K times Y. That's the difference between these two. If you work one more year, you get 1 minus K times Y more. This is the questions about that. Why is this important? Because this K term effectively is a tax. Think about it. If I work one more year without Social Security, what do I get? Y. If I work one more year with Social Security, I get 1 minus K times Y. Why is that? Because I'm giving up the money I could have had by sitting at home. And my decision is always sitting home versus working. So it's a trade-off. The bigger K is, imagine K was 100%. Imagine K was 1, and leisure's normal. Would anyone work past 62? No. Why'd you work past 62? You get the same thing. If K is 1, that means if I work, I get Y, and if I'm home, I get Y. And leisure's normal. Why would I ever work? So the bigger K is, the bigger the moral hazard is. The less incentive there is to work. Okay? So what do we do in the US to offset that? We have a simple, what I call actuarial adjustment, which is we say if you work till 63, we're going to give you an extra bonus. We're going to give you Y plus 17 times K times Y times 1.067. We're going to give you more. And that 1.067 is calculated so that you're indifferent. So the average person is indifferent. Yes, they give up K, but they get more per month. And it's calculated so the average person is indifferent. Okay? So roughly speaking in the US, when you decide to retire 62 or 63, Social Security shouldn't affect that decision.
But why is it calculated to the point where you're indifferent, the average person is indifferent, rather than incentivized to work a little bit more if the goal is... I like it. Well, I guess if you make it so that you're indifferent, then because the cost of the cost of incentivizing making it not indifferent, where you're incentivizing people to work longer, is that your people who shouldn't be working are still working, right? But then this is when you start thinking about it a little bit, it gets really complicated. But I guess if you make it indifferent, then you're allowing people to reveal their preferences and assuming that they are the best judge of whether or not they're still productive, I guess, or something like that.
It's basically pretty neutral. Now let's go to the Netherlands. In the Netherlands, two things are different. K, instead of being 0.5, is 0.9. B, the second thing different, they don't have this. So in the Netherlands, your decision is, do I work? Age 55 is early retirement age. Your decision is, do I work till age 55 and get Y? Do I work my 50th, 60th year and get Y? Or do I stay at home and get K times Y, which is 90% of Y? Okay? People understand that? That's your decision. But it's even worse than that. Because how does the Netherlands pay for this program? By taxing workers. Taxes you don't pay if you don't work. So if you work, you get Y, but you lose almost half it in taxes. So you get half Y. If you don't work, you get 90% of Y. You make money by not working.
Oh, that... Oh, no, that can't be...
Even MIT students might find that attractive. As a result, literally no one works past age 55 in these countries. We essentially made it not in their financial interest. So
interesting. Okay, Netherlands. Simple. Benefits 90% of income, but also not taxed. Which isn't taxed.
Some people go back to work off the books and sort of jobs that aren't recorded. They can make some money. But that's why you see all these old people sitting around cafes in Europe having a great old time in the middle of the day. Because basically...
It's important to to distinguish, there's a lot of good and bads thrown in here, but we're kind of playing fast and loose with the good and bad, because sometimes we mean typically we mean, I think, good and bad for the economy, and sometimes we mean good and bad morally, and sometimes we mean good and bad in terms of welfare surplus.
There's no financial benefit to working. We're essentially making you indifferent in working and non-working once you reach retirement age.
Whenever you see good and bad here, just make sure that you're getting the right, because even though it says moral hazard, this isn't. I wouldn't say that this is morally bad. You know, this is a, I don't know. It's because this is not necessarily morally good or bad, but it's bad for the economy. Yeah.
So that is an example of moral hazard. That's an example of setting the benefits too large, so that the moral hazard benefits, the moral hazard cost is enormous
Unless
relative to potential smoothing. If the Netherlands, for example, lower than 90%, or even just introduce a factor like this, that would offset things a lot. So the point is, this is sort of a wonky discussion, but the point is this shows you how these little wonky numbers that policymakers fight about all the time can have a fundamental impact on the way the entire economy functions. Literally, by setting K to 0.9, and by not having this actuarial adjustment, the Netherlands has essentially taken every old person out of the labor force. That's a pretty fundamental change, and that's something that policymakers, that's why I love policymaking, that's what policymakers need to think about, is essentially what are the unintended consequences, what I started the semester with. I want to insure people in the Netherlands if they can't work anymore, but I don't want to take every old person out of the labor force, and that's what they end up doing. Okay? That's all I got for today. Hope you guys had a good Thanksgiving, and we'll come back Wednesday.
Great lecture, though. Fantastic. Efficiency and equity. 1, 2, 3, 4. 4 left. 4 left. Equity. Is there anything else that I want to add to the super important section? Not really. These are like examples of the two. Really, these are the two key concepts. Yeah. All right. That was fun. We'll keep going next time. Interesting. I need to work on this. I need to tidy up my super important notes and make sure that I have enough there. I need to decide how this is gonna work. And I probably need to go back through things just to make sure I haven't missed anything super important in my core concepts. Yes. Cool. Anyway, that was fun. Catch you next time. And hopefully you enjoyed the lecture. That was awesome.